Let's widen things out once again and talk about what's going on in the market today with stocks higher as inflation pressures remained persistent in February. Now, with the tension shifting back to Jay Powell, investors are trying to map out when that first rate cut may be coming. For more, let's bring in Liz Young, SoFi head of investment strategy. Hey, Liz, it's great to see you.
Hello, good to be here.
So, you looked at these numbers this morning, and I have to say, you might have expected to see quite a different equity market outcome with those numbers coming in a little bit hotter than estimated. So what happened?
What I think is going on right now, and I don't want to say that the macro data doesn't matter, it certainly does matter, but I think equity markets are first and foremost queuing off of what Jerome Powell sounded like last week. He sounded pretty dovish. He sounded like they were still planning on cutting rates at some point this year, which is what we were expecting. And if you look at the Fed funds futures, they didn't really move at all, regardless of the fact that CPI came in hotter than expected. So still looking for that first cut possibly in June, and still looking for about 3 cuts by the end of the year. So that didn't change much at all. When you look at what the numbers were, we got some hotter CPI numbers in January. We've heard the explanation that this is seasonal. This happens in the beginning of the year. So I think we had a little bit of a buffer to expect slightly hotter numbers than what the survey said. But like you said, the odd reaction here is that you've got tech leading today, so that sector that's the most interest rate sensitive on a day when yields are up in response to inflation data. And the other thing I would point to is the Fed cues off of inflation expectations as well, because the last thing they want is for inflation to become entrenched. And the way that they measure that, one of the ways they measure that is by looking at inflation expectations. And a way that you can measure inflation expectations is by the breakeven rates. And if you look at the 2-year breakeven rate, it's gone up more than 75 basis points since the end of November. That is a really big move. The 5 and 10-year rates haven't moved much, but that 2-year rate has gone up quite a bit. So that means that inflation expectations are rising. And the risk here, I think, really to the equity market is that the Fed has more stamina, a higher threshold for pain than stocks do. So people keep buying. And what if the Fed says, we're not ready to cut yet because the data doesn't tell us that it's the right time?
Liz, fascinating comments then. So let's think through to the next FOMC meeting. Where do you see the dot plots landing, and how do you think Powell will characterize, what will be the tenor of his tone? Will it be hawkish, dovish? Is he going to have to walk back some of the expectations that have been built in for these rate cuts, which remain today?
Well, luckily for him, they haven't given many concrete expectations about those rate cuts. They've been intensely vague about what they intend to do. And I think that's been on purpose, and that's been the safe route. He's continued to say that phrase of, we need to feel confident that inflation is on a sustainable path toward 2%. What we're seeing in the data, obviously CPI is different than PCE, but what we're seeing in the data is that it's plateaued. So it's not necessarily going back up at a concerning rate, but it has plateaued. We had this huge drop off of peak inflation, and now we're at this place where I heard the joke recently that last 5 pounds that you're trying to lose is always the peskiest, and that's where we're stuck. And the thing that's keeping it stuck there is services inflation. Now we can explain some of that away by saying it's all shelter, it's everything in the housing market that's skewing it, and that's such a lagged effect. And some of that is true, but we're starting to see other little pockets pop up as problems, something like auto insurance. We've never talked about auto insurance being an issue before, and now suddenly auto insurance is an issue. So I think what we're going to see for the next few months is inflation data that isn't as promising, perhaps, as we were hoping it would be. And I think Powell is going to have to acknowledge that. But to be fair, I think he has acknowledged that. And the market just is choosing to decide for him what we think the Fed is going to do later in the year.
Yeah, Liz, I like that last 5 pounds analogy too. It's a little more evocative than the last mile, right? Like, why is it so hard to do the last mile? We know it's hard to do those last 5. So if inflation is going to be more persistent, if we're going to hear maybe more talk from the Fed about that, what effect does it then have on your investments, right? What effect does it have on risk assets, for example, which, as you noted, are still doing pretty well today?
Right. Well, and today may end up just being an anomaly, sort of a strange reaction in the market on the idea that the economy is still strong. Yes, inflation has come down, but we can withstand it and absorb it. What's interesting about what's happened even since last October is as we continue to push rate cuts out, stocks still did okay. They still, in the face of that, did okay. So if the idea was that things had fallen into October due to the idea that things were getting worse or because rates had risen again, it turns out we ended up absorbing it just fine. I don't know how long that can last. Again, I go back to my earlier comment. I think the Fed's stamina is stronger than the market stamina here. But the way that so far the market has tried to withstand it is by rotating. And now that's not happening as much today, but rotating out of some of those very obviously crowded trades, very obviously overbought certain stocks or even certain themes or sectors or whatever the case may be, and rotating into other parts of the same sector. So maybe out of really big cap tech that's seen a good run and into some of the old school tech that hasn't kept up as much, or rotating into more cyclical sectors that have lagged for the better part of the last 12 months. So that's how the market has been digesting this and still showing strength. And that's where that broadening out narrative has come from as well.
Liz, I'd like to stick with this broadening out narrative and talk a little markets and further sector action. You mentioned a couple of sectors broadening out from the tech rally. Materials is one, too. Healthcare is another. Financials, industrials. There have actually been a broad base of support here from some of these other industries. I'm just wondering what you happen to like or see as potential in particular.
Those are definitely the ones that have proven the broadening out narrative. The healthcare one, it has been there for a while, and I think that's much more of a thematic move, the weight loss drugs and everything that's happened along that vein. But materials, industrials have had a really nice run. Materials, I think, are responding to the idea that inflation isn't in fact falling, or that we don't have deflationary pressures, and that perhaps the economy is stronger, which means that global demand should stay stronger. Energy has come off the mat a little bit. And then you mentioned financials. So I think some of that is that rotation back into, okay, what if we are more mid-cycle than late cycle? What if the economy musters through this and we manage to have that soft landing, or at least solidify that soft landing, in which case cyclicals should do well coming out of that and should survive any little contraction that we may have. So I think that's part of what's going on here. What you do want to see, though, is that investors, and this has happened, investors come in when we see little pullbacks and buy different things. And that shows us that, okay, we didn't have to rely on 7 names in the index to carry us all the way through the year. Now maybe we can look to other sectors to pull some of their weight. The concerns that I still have are that I still believe that we are more late cycle than mid cycle. I believe that we're in a period where this is a very elongated late cycle, perhaps the longest one that we've lived through. But I still believe that there's late cycle behavior going on. And the big question is, are we seeing late cycle euphoria driving markets upward? Or is this more of an expansionary phase that you would see early or mid cycle? I think we're seeing a little bit more late cycle euphoria, which you could also call something like the FOMO trade.